Hi, welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Patsarthi. And in this week's Search for Yields, I'm going to give you a very fundamental fact on fixed income investments. And that fact is that 1 year returns matter a lot in fixed income investments. In the Search for Yields, you will learn why 1 year return matter a lot in fixed income investments. Just before that, do not forget to download our app, QuickInvest by INR Bonds, where you get the best curated bonds for your fixed income investments, which gives you the yields and returns required along with the risk profile that is necessary for your portfolio to earn better returns with a good risk adjusted return. Download the app on iOS and Android.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Back to search for yields. The why 1 year returns matter on fixed income investments. So let's take a very simple example of four different bonds. Let's take one bond is returning yielding 4% in 1 year. The second bond is yielding 6% in 1 year. The third bond is yielding 8% in 1 year. And the fourth bond is yielding 9% in 1 year. And let's just assume that inflation is at 6%. Let's take it as 6%. Then coming down to the second year, now let's assume that because inflation is high, interest rate also move up. And the second year, the bond 1 yields 6%. The bond 2 yields 8%. That is, interest rates have gone up by 2%. Bond 3, because it was a higher yielding bond, it's yielding only 9%, because only 1% higher. And bond 4, which is at 9%, is yielding 9% only because it is a interest rate insensitive bond, right? And let's take the third year exam as well, because interest rates are moving up because inflation is still high. And the bond 1 is yielding 8%. Bond 2 is yielding, say, 10%. Bond 3 yields 10%. And bond 4 yields 10%, right? Because the higher yielding bonds, the interest rates are incentive. This is just an example. But if you work out the 3 year average, if you take the first bond, it's only 6%. So that means investors who's earned 4% or 6% in the first 2 years have lost out completely. And if inflation is averaging 6%, they earn 0% on their investments. On the second bond, it's slightly better. They earn something like over 8%. 8% is average. On the third bond, they earn over 8% on average, closer to 8.4%. And on the fourth bond, they earn more than 9% on an average. So clearly, if an investor has to earn decent returns over a 3 year period, it is important that returns every year is reasonably good enough so that the next 2 years need not be very high returns for an investor to get a good average 3 year kind of a return. So in some periods of time when interest rates are very low, then it's better to look at bonds that are yielding higher. When interest rates are very high, then automatically the returns on the bonds itself will be enough to make sure that inflation is the returns are pretty much okay, especially when if the interest rates fall, then the bond prices too rise, and investors also get the benefit of capital gains. So it's very important for investors to understand why it is 1 year. It's always good to look at 1 year returns rather than a 3 year return. and how best to maximize 1 and 2 year kind of returns to get a good 3 year return kind of an average. This is especially true for financial advisors who are struggling with fixed income investments for their clients. Many products in the last couple of years have earned nothing, and so 3 year returns are looking very, very poor. Investors have and inflation is at trending at 7% now. Investors have actually suffered huge capital loss when they have earned very less on 1 year. Whereas investors who have invested in bonds, for example, yielding 8 to 9% or even 10%, they are very much happy with what they have got because they are beating inflation on a yearly basis and also able to ability to reinvest at higher yields or earn higher returns on their investments. So, coming down to if I have to conclude, investors will always have to look at what 1 year returns. So it really doesn't necessarily mean that investors have to invest in 1 year bonds yielding 7, 9% or 10%. Investors could also look at long-term bonds. Supposing an investor is happy with a bond that is giving 9% coupon for 10 years, then that itself is a good return for the investor. But the only thing is that here investor may make sure that they have to own the bond for 10 years. And it has to be a good bond with enough good credit profile because we don't want any kind of credit issues down the line. And if they have to sell and interest rates are higher, then investors could actually lose out on the returns and because they'll suffer a capital gains loss. So that's where the search for yields ends this week. Do not forget to subscribe to your YouTube channel if you've not done so already. And as mentioned at the beginning, download our app, QuickInvest Buy and our bonds for the best bonds for your fixed income portfolios. Thank you very much.